Count the dark floors yourself. Anyone standing on Sheikh Zayed Road after 9 p.m. can do it. And the number keeps climbing. 32, 41. On one tower near Business Bay, I counted 63 consecutive floors with no lights on at all. Not dimmed, not curtained. Dark. The kind of dark that means nobody's home, nobody's been home, and the building management has quietly stopped pretending otherwise. From ground level, these towers look like monuments. From a distance at night, they look like what they are. $50 billion worth of vertical ghost towns rising out of the desert. And that number isn't hyperbole. According to property consultancy ValueStrat and data compiled by Dubai's own real estate regulatory agency, the estimated combined development cost of Dubai's current unsold and unoccupied luxury residential inventory has crossed the $50 billion threshold as of early 2026. That figure accounts for completed towers, partially completed towers, and towers that were sold off-plan to buyers who never moved in, and in some cases, never intended to. This isn't a market correction. This isn't a seasonal dip. This is a structural misalignment between what Dubai built and what the world actually needs. And right now, the skyline itself is the most damning piece of evidence. Let's talk about how we got here. Because this didn't happen overnight, and the story is more complicated than any headline can capture. Between January 2023 and March 2026, Dubai approved construction permits for over 120,000 new residential units. During that same window, according to CBRE Middle East's quarterly absorption reports, the market absorbed roughly 58,000. That leaves a gap of more than 60,000 units. And that's being generous with the absorption numbers, because CBRE counts a unit as absorbed the moment a sale closes on paper, not when someone actually moves in, unpacks a suitcase, and starts paying utility bills. The real occupancy gap is almost certainly wider. Some analysts estimate it could be double. Now here's the part that makes this worse. Per square foot prices in prime Dubai neighborhoods, Dubai Marina, Downtown, Palm Jumeirah, surged between 2021 and mid-2024. We're talking 30 to 45% increases depending on the district, according to Knight Frank's Dubai Residential Market Review. Developers took that price surge as a signal. Build more, build taller, build faster. But what was actually driving those price increases wasn't organic housing demand. It was a speculative wave fueled by a very specific post-pandemic migration. Remote workers chasing sun and zero income tax. Crypto investors converting volatile digital gains into physical concrete. Russian capital in urgent flight after sanctions, and Indian high net worth families diversifying their assets offshore. That wave peaked somewhere around mid-2024. And when it receded, it left behind a coastline of empty glass stretching from the marina to Dubai Creek Harbor. Multiple sources within Dubai's real estate sector, speaking anonymously due to contractual and professional obligations, describe a market in quiet panic. Developers are now offering 18 to 24-month post-handover payment plans, full furniture packages, service charge waivers, and in some cases, outright rent guarantees just to move inventory off their books. One source at a major Emirati development firm told a regional business outlet that their unsold stock had tripled since mid-2024. Tripled. And they're not alone. A second source, this one, at a brokerage with over 200 agents across the city, said commission structures have been slashed because deal volumes have plummeted, even as listing volumes explode. Here's what that looks like on the ground. The infinity pool on the 57th floor has been drained since November. Not for maintenance, not for winter. Drained because the operating cost of keeping a pool heated and chemically treated for 4 residents in a 310-unit building doesn't make financial sense. The spa level, marketed as a world-class wellness destination in the original glossy brochure, has never opened. The equipment was installed. The tile was laid. The door has never been unlocked for a paying customer. The concierge desk in the lobby is staffed by a single employee between 8 a.m. and 4 p.m., and after that, you'd need to call. A mobile number taped to the marble counter with scotch tape. This is a building that was handed over 18 months ago, with a starting price of 4,200 dirhams per square foot. According to residents who spoke with Gulf property journalists, fewer than 70 of those 310 units are occupied. That's a 77% vacancy rate in a building that was supposedly sold out. Walk through the parking garage and you'll see it. Row after row of empty bays. No scuff marks on the concrete. No oil stains. These spaces have never held a car. Take the elevator to the 40th floor and step out into the hallway. The carpet is pristine, not because it's well maintained, but because nobody walks on it. The fire extinguisher tags haven't been checked since installation. There's a particular silence in an empty luxury building that's hard to describe if you haven't experienced it. It's not peaceful, it's expected. Like the building itself is waiting for a life that was promised in a sales office over champagne, but never actually showed up. And this pattern repeats across dozens of developments throughout the emirate. According to data aggregated by Property Finder and Bayut, Dubai's two largest property listing platforms, the number of available rental units in premium categories increased by 38% year over year between Q1 2025 and Q1 2026. Asking rents in some towers have dropped 15 to 22% from their 2024 peaks. And time on market for luxury listings has stretched from an average of 18 days to over 60. The velocity of the market has collapsed. The supply hasn't. It just keeps coming. To understand why these towers exist in the first place, you have to understand who was never expected to live in them. A significant portion of Dubai's luxury residential pipeline was never designed for residents. It was designed for investors, specifically off-plan buyers purchasing units 2 or 3 years before completion, often with payment plans requiring as little as 10 to 20% down during construction. The bet was simple, and for a while it was almost foolproof. Buy early, watch the paper value climb during the build phase, and either flip at handover for a tidy profit or hold long-term for rental yield. Between 2020 and 2023, off-plan transactions in Dubai surged by over 60%, according to the Dubai Land Department's own published transaction data. Developers printed money. Brokers earned 6-figure commissions on single deals. Marketing teams won awards, and the cranes kept spinning. But here's what nobody talked about publicly. What the industry knew, but had no incentive to say out loud. A meaningful share of those purchases were tied not to housing demand, but to capital preservation and geopolitical escape hatches. Post-2022 sanctions drove an estimated $6 to $8 billion in Russian-linked capital into Dubai real estate, according to estimates cited by the Financial Times and Bloomberg. Indian buyers, facing tightening domestic regulations on outward remittance under the liberalized remittance scheme, found Dubai's Golden Visa program, which grants a 10-year residency, to property buyers spending over 2 million dirhams, an irresistible dual-purpose investment. Chinese investors, navigating increasingly aggressive capital controls at home, used Dubai as an offshore parking structure for wealth. Not a home. Not even an investment in the traditional sense. A vault with a view. The result? Towers that were fully sold on paper, but functionally empty. Bought not to live in, not even to rent out in many cases, just to hold. And when market sentiment shifted, when global interest rates climbed, when crypto portfolios cratered by 60%, when the novelty and urgency of Dubai's post-pandemic boom faded into normality, those same investors had no emotional attachment to the asset. No furniture in the unit. No children enrolled in a local school. No favorite restaurant down the street. Nothing keeping them tied to a specific apartment, in a specific tower, in a specific neighborhood. So they listed, or they defaulted on their payment plans, or they simply stopped responding to management emails and vanished. Priya Menon managed 12 luxury units in Business Bay. And by February, 9 of her tenants had given notice within the same 6-week window. She's been a property manager in Dubai for 7 years, and she told a UAE-based real estate podcast that she'd never seen anything like it. It wasn't one building, she said. It was across my whole portfolio. People were either leaving Dubai entirely or downgrading hard, moving from new builds into older, cheaper stock in Deira, or international city. The new towers just couldn't justify the premium anymore when salaries were flat and rents everywhere else were falling. Priya's experience isn't unusual. According to a survey conducted by Asteco, one of the Gulf region's oldest and most respected property management firms, landlord vacancy rates in Dubai's premium residential segment rose from 11% in mid-2024 to over 19% by early 2026. Nearly 1 in 5 luxury apartments sitting empty. Then there's James, not his real name, a British expat who bought a 2-bedroom apartment in a JLT tower off-plan in 2022 for 1.8 million dirhams. He paid 40% during construction and financed the rest at handover in late 2024 through a UAE mortgage. "The day I got the keys," he said in an interview with a Gulf finance outlet, "there were maybe 15 other people in a building designed for 400 families." He tried renting the unit out immediately, listed it on every platform, dropped the price 3 times over 8 months, got 3 total inquiries. None converted into a signed lease. He's now paying a mortgage on a unit that generates 0 rental income in a building where the annual service charges keep climbing because the fixed costs of security, maintenance, cooling, and elevator operation are being divided among fewer and fewer occupied apartments. "I'm trapped," he said. "I can't sell it for what I owe. I can't rent it. I can't just walk away because my residency visa is tied to the ownership." James represents a growing demographic in Dubai's property landscape, the reluctant bag holder. People who bought into a narrative of permanent appreciation and are now subsidizing empty buildings with their monthly payments. And his story points to a structural risk that developers and regulators have been slow to acknowledge. When a tower's occupancy falls below a critical mass, the economics of maintaining it become punishing for the few residents who remain. Dubai Land Department officials have pushed back firmly against these vacancy narratives, citing a 12% year-over-year increase in total transaction volume. But here's what that number obscures. Transaction volume and occupancy are 2 fundamentally different metrics. You can have a booming sales market and a hollowing occupancy rate simultaneously, because every resale, every distressed flip, every investor-to-investor trade registers as a transaction in the statistics without adding a single new resident to the building. It's musical chairs, not musical homes. Officials have also pointed to Expo 2020's legacy developments and the continued influx of multinational companies relocating regional headquarters to Dubai as evidence of sustainable long-term demand. And that's a fair point, to a degree. Corporate relocations are real. They create genuine employment and housing demand, but they tend to drive demand for office space and mid-range housing, not for 4,000 dirham per square foot penthouses in towers with private elevator lobbies and Italian marble lobbies that echo when you walk through them alone. The government has introduced new regulatory measures, including strengthened escrow account requirements for developers, stricter off-plan advertising rules, and a new real estate price index aimed at improving market transparency. These are meaningful, well-intentioned steps, but analysts at JLL Savills and S&P Global Ratings have each noted independently that supply-side controls remain conspicuously weak. There is no effective mechanism in place to throttle new construction permits in oversupplied market segments. And as long as developers can sell off-plan units to offshore buyers faster than they can physically pour concrete, the incentive structure keeps pointing in one direction. More towers, not fewer. The construction pipeline for 2026 and 2027 alone includes an estimated 41,000 to 55,000 new units, according to Knight Frank's forward projections. That is not a market correcting itself. That is a market accelerating toward a cliff edge while checking its reflection in the rearview mirror. Empty towers don't just sit there passively, they bleed value into everything around them. When a residential building operates at 30% occupancy, the restaurant's leasing ground floor space close. Then the dry cleaner, then the pharmacy, then the coffee shop that was supposed to serve 400 families but now serves 40, and the unit economics don't work at any price point. Retail vacancy in Dubai's newer mixed-use developments has risen in near-perfect lockstep with residential vacancy. According to JLL's latest UAE retail market update, Ground floor retail units in post-2022 residential towers are experiencing vacancy rates above 40% in some corridors. Walk through the base of these buildings and you'll see it. Shuttered storefronts behind tinted glass. Coming soon signs that have been there for 18 months, and the occasional lone nail salon that somehow keeps going. Then there's the hospitality cascade. Dubai's entire tourism pitch depends on an image of vibrancy, of streets that hum, of rooftop bars that pack out at sunset, of a city that never sleeps and never stops moving forward. But when entire districts feel underpopulated, when you can walk through what should be a bustling waterfront promenade and hear your own footsteps, that image develops cracks. Hotel occupancy across Dubai averaged 73% in 2025, down from 77% in 2023, according to STR Global data. That's still respectable by global standards, better than many major cities. But the trajectory is heading in the wrong direction, and the profit margins in Dubai's ultra-luxury hotel segment are thinner than the gold leaf on their bathroom fixtures. Several five-star properties have reportedly shifted to aggressive discounting strategies, room rates and package deals that would have been unthinkable 2 years ago, just to maintain enough cash flow to service their own debt. There's a deeper brand risk here too, and it might be the most consequential of all. Dubai has spent decades and billions of dollars in global marketing, campaigns, cultivating an image of success, exclusivity, ambition, and forward momentum. That brand is arguably the Emirates' single most valuable economic asset, worth more than any individual tower or development. But brands are fragile things. And when international media outlets start running stories with the words "ghost towers" in the headline, when travel bloggers and social media influencers post walking tours of deserted lobbies that were designed to impress, that narrative takes root. Perception and reality begin to converge. And in a market built substantially on the power of perception, on the idea of Dubai as a destination and a symbol, that convergence isn't just uncomfortable, it's potentially existential. For this situation to genuinely correct itself, 3 things would need to happen more or less simultaneously. First, the pace of new construction would need to slow dramatically, not by 10 or 15%, but by 40 to 50%, to allow the massive existing inventory backlog to be absorbed by real occupants. Second, rental yields would need to stabilize at levels that attract long-term buy-and-hold investors rather than short-term flippers, which almost certainly means a sustained price correction of 20% or more across the premium segment. And third, Dubai would need to fundamentally shift its value proposition from luxury spectacle to genuine livability. Investing seriously in the public schools, the healthcare systems, the public transit networks, and the community infrastructure that convince families to stay for a decade, not just a tax cycle. Some of those investments are underway. The Dubai Metro expansion is real and significant. Educational offerings have improved noticeably, but these take years, sometimes a full generation, to compound into the kind of genuine livability that anchors a population. And the supply glut is compounding much, much faster. Here's why that correction is unlikely to happen cleanly. Every single one of those 3 necessary conditions runs directly against the short-term financial interests of the developers, brokers, banks, and government entities that collectively drive Dubai's economic engine. Slowing construction means slowing GDP growth in a city where real estate and construction represent a massive share of economic output. Allowing price corrections means accepting write-downs on bank balance sheets already stretched thin. Investing in livability is expensive, slow, and unglamorous. It doesn't generate Instagram content, or sell units in a sales center with a scale model and a champagne bar. The path of least resistance is to keep building, keep marketing, keep selling the dream, and hope that the next wave of global capital, from wherever it originates, fills the gap. Maybe it will. Markets have surprised us before. But hope is not an economic strategy, and the dark floors on Sheikh Zayed Road don't respond to marketing campaigns. Dubai isn't the first city to build faster than demand could follow, and it won't be the last. The pattern is older than skyscrapers themselves. Speculative overbuilding driven by cheap capital, lax supply-side regulation, and the intoxicating, almost addictive belief that growth is a permanent condition rather than a phase. We saw it in Miami's condo glut of 2008 when entire waterfront towers went from ribbon cutting to foreclosure in 18 months. We've seen it in China's ghost cities across Henan, Guizhou, and Inner Mongolia. Entire urban districts built for populations that never materialized. We saw it in Spain's Costa del Sol developments that sat empty and decaying for a full decade after 2009. Monuments to a boom that evaporated overnight. The architectural styles change. The marketing language evolves. The underlying economics never does. What makes Dubai's version of this story particularly significant is the sheer audacity of the bet. This is a city-state that has wagered its entire global identity on a single proposition, that if you build it, taller, shinier, more extravagant, more Instagram-worthy than anywhere else on Earth, they will come. And, for a remarkable stretch of time, they did. The question that hangs over every dark floor on that skyline tonight is whether the world has shifted in ways that Dubai's model simply cannot accommodate. Remote work permanently reshuffled where high-income professionals want to live. Geopolitical fractures reshuffled where the capital wants to park. Accelerating climate projections reshuffled how institutional investors evaluate long-term real estate risk in a region where summer temperatures already push the boundaries of human tolerance. And a rising generation of affluent consumers reshuffled what luxury even means. From square footage and gold fixtures to walkability, cultural depth, environmental responsibility, and genuine community. $50 billion in glass and steel, rising out of the sand, waiting for occupants who may never arrive. That image isn't just a story about one city in the Gulf. It's a mirror. And every city on Earth chasing the same model, building skylines. For investors, instead of residents, prioritizing spectacle over substance, selling a future that the present can't support, should be paying very close attention to what that mirror is showing. This is an evolving story, and based on the construction pipeline data alone, the next 12 months are going to be decisive. If you want to follow what happens next, subscribe. We're tracking these trends in real time, and the data we're seeing behind the scenes suggests the biggest shifts haven't played out yet. Drop your thoughts in the comments, especially if you've been on the ground in Dubai recently and seen these changes with your own eyes. I read every single one. And if this analysis made you think twice about what those glittering skylines actually represent, share it with someone who needs to see it. Because this story is far from over.